Let's talk about the economy, the complications from policy, and what kind of language maybe Jerome Powell is going to use tomorrow. Danielle DiMartino Booth is here, CEO and Chief Strategist at QI Research. Danielle, good to see you this morning.
Great to see you. Thanks for having me.
So how much is all this tariff policy stuff going to interact with the overall economic trajectory and Jerome Powell's mission to try and keep getting inflation to stay in line?
Well, I think that given some of the signs that we're seeing that are a lot more disinflationary in nature, and especially with that big pop that we saw this morning in Challenger grain Christmas job cuts for the month of February of 172,000. Yesterday, ADP missed. Something tells me tomorrow that Chair Powell is going to be a lot more focused on what we hear at 8:30 a.m. Eastern about non-farm payrolls.
I knew that you were likely to mention that print this morning. I know last time we talked, you're looking for continued slowdown in the economy. So if the kind of baseline then is things are going to break down, does the tariff stuff increase the odds, fast forward the timing, or are the things you're monitoring more kind of structural in nature?
So you know what was interesting a few days ago was that when it looked like for less than 24 hours, we were actually going to have 25% tariffs across the board in Mexico and in Canada, we actually saw bond yields fall. And that's kind of a reaction to the effect that the tariffs had on the economy in 2019, the damaging effect on the U.S. industrial sector, the number of factory job cuts that occurred as a consequence of the tariffs were actually more damaging to the economy than any inflation that we saw on the good side when President Trump in his first term first tweeted out that there was going to be a trade war with China, which was April 2018. The CPI was actually at a higher point then than what it was at the end of 2019 because of the drag effect on the industrial and cyclical sides of the economy as a consequence of those tariffs. So it's a bit of a pull and a push with the Fed, and that's what they're going to be looking for. But again, they do have a second employment mandate in addition to their inflation mandate.
Okay. And employment, how fragile does it look to you, Danielle? Where might we start to see in the calendar the further breakdown? Do you think that we are kind of on a precipice of a major employment breakdown?
Well, that's beginning to be what is the case. Bear in mind, of that 172,000 in Challenger this morning, and I'll put in air quotes here, only 62,000 were related to government job cuts, meaning it was really a private sector heart attack in the labor market. And that's indeed what we've been seeing. The number of multiple $100 billion plus bankruptcies we've seen this year is quite alarming. I track bankruptcies very closely, and you kind of pay attention when liabilities of the company filing for Chapter 11 are kind of north at that 50 million mark. But we've seen multiple $1 billion liability type of bankruptcies this year, and that's going to hurt. That's going to hurt the job market.
Do you think that's why we've seen some of the housing slow down and vehicle sales slow down? Are we just going to kind of keep seeing the higher ticket stuff come off, or? I guess this is kind of gets into our second part about what the Fed might do, so I don't want to jump too far ahead, but, does any of that change if rates come down enough?
Well, it was that very last word you used that was key, and that's enough. Yeah, it really is, because if there's one thing that will trump a falling mortgage rate or a falling car loan rate, it's whether or not you've got the ability to verify your income. And so that's where things get really, really tricky here. I think one of the reasons that we're seeing, I think Bankrate put out a survey that showed that 48% of Americans who had applied for credit in 2024 were rejected after they submitted that application. I think part of what we're seeing is kind of a latent credit crunch effect where lenders really are tightening up the reins in terms of who they are and are not going to extend credit to, which again goes back to the job market. And that's when Fed policy becomes somewhat impaired. It's that they have to drop those rates enough to make a difference in borrowing rates that supersedes whatever's going on in the job market.
What role in inflation or the stability of the economy do you think asset prices are playing right now, Danielle? Even if we just kind of zoom out, obviously we're off the highs here, but if we zoom out, of course, it's been an extraordinary post-COVID period for investors and risk takers of all forms, from crypto to stocks. And there is kind of this narrative building I've been hearing that maybe a Trump administration 2.0 is going to be less concerned with stocks. If they want to get rates down, maybe a way to do it is to apply some pressure to the stock market. And it kind of looks like maybe that's what's happening so far. What would be the impact if they were okay with letting the stock market drop?
Well, that would be kind of a game changer. You'd start asking yourself, who's on the short side of this trade? But by the same token, if the Trump administration is willing to look towards his legacy and take a little bit of short-term pain for long-term gain, so to speak, the Wall Street Journal had a good report out a few weeks ago that showed that the top 10% of American earners account for 49.7% of spending. As you know, GDP in the United States is 70% consumption. So if we do start to see a reverse wealth effect, then that could have major implications for spending in this economy and really put the brakes on.
So it might work. It's a theory so crazy, maybe it makes some sense to a degree, and maybe it makes Powell's job a little easier, perhaps, if he has clearance from a bear market in stocks to start cutting this year.
Well, I think easier's maybe in the eye of the beholder there. If the Fed is rushing to lower interest rates to try and get behind a slowing economy or potentially a recession that becomes public, and of course, more than 50% of Americans foresee the unemployment rate rising in the next year. The University of Michigan Conference Board, these confidence numbers have been horrific. But once we are usually in that situation where the majority of people say, hey, things are going to get worse, we're actually already in recession. I wouldn't want to be in the position of the Fed where coming into the year, you're like, oh, just 2 rate cuts and that's it. We're going to be stingy. And then they're riding back in from behind going, wait a minute, here's another 50 basis point emergency jumbo rate cut like we had last September the 18th.
Do you think Powell will hint at anything that's been happening market-wise tomorrow?
I think that if there is downside, as we have seen potentially with ADP, as we've seen with some of these huge downward revisions, if there's any kind of a surprise in non-farm payrolls tomorrow morning and 4 hours later when he's at the podium, he ignores it, that would really surprise me. By the way, it's unusual to see the chair of the Fed be kind of the caboose of Fed speakers going into FOMC blackout, which begins tomorrow. Right after tomorrow, nobody can say anything until the Fed releases their statement on March the 19th. So it's unusual to see Powell being the last speaker as the headliner. So I would expect that he will be reacting to the jobs report.
Okay. Great stuff, Danielle. Always like the perspective and always love the conversation. Appreciate your time.
Thank you.
Fun chat, bouncing some ideas around. Danielle DiMartino Booth, CEO and Chief Strategist for QI Research. Good thoughts on Powell responding to the employment report tomorrow morning. Should be a fun session for those interested in the economy and the Fed tomorrow.